Welcome, everybody, to the Real Estate Investment Education Club at Intel for February 26, 2021. Today, our guest speaker is KK Singh. If you're new to the club, and I know that some of you are, welcome here. We have a SharePoint that has all of our previous speakers. So last week, we had Jason Artman coming in and talking about, let's see if I can say it correctly, inflation-induced debt destruction, or in other words, how does inflation help the borrower? And before that, we had Guillaume, spelled his name wrong, who talked about infinite banking, or the AND asset. So if you want to find the previous speakers that have come here, and we've had quite a few of them over the last year and a half, just go to the SharePoint site, search for Real Estate Investment Club. You'll find it. I'll stick it here in the chat box as well. There we go. And other than that, if you want to hear more from KK, I actually had him on my podcast, episode 93 of the Win Multifamily Show. We've actually since stopped publishing this podcast, and we've rebranded to the Real Estate Investing for Professional show. But if you're interested in hearing a podcast from him, and I know, KK, you've been on a lot of podcasts, right?
Yep, about 24.
Yeah, we could 24. Okay, well, you can find him on all sorts of real estate podcasts then. All right. As people are joining, let me take a moment to see how many people are in the room. Oh, we've got 80 people on now. Okay. Well, people are probably going to continue to come in for the next 2 to 3 minutes. But one other announcement, actually, before we go to KK. We had one of our speakers decide that they were unable to make it on March 12th. And so the real estate roundtable discussion that we've talked about for quite some time, we're putting it on March 12th. And so far, 5 out of the 6 panelists have confirmed that they can make that time. We've got 3 Intel employees, 1 Intel employee who works with mortgage notes, 1 Intel employee who is a single-family home investor, and then I'll be the Intel employee representing multifamily home investing. And then we have 3 brokers, the brokers that have been coming in to do our market updates. Tina Sloat is from Arizona, Andrea Dwab from Folsom, California, and then we're going to have a new real estate agent for Portland. He hasn't yet spoken in our group, but I know when he does, he'll do a great job. So March 12th, we're having our roundtable discussion. Think about the questions that you want to ask. And in fact, I'm going to put up on the Yammer group just an open invite for people to post their questions. So I'll do that after this meeting, and you can just reply down in the comments what your questions are for any of those topics, or if you think there needs to be, a different topic represented there. One of the upcoming topics that we are going to be looking at, or some of the upcoming topics, are listed here. I've updated the upcoming meetings page. And so we have the next set of people coming in on infinite banking, due diligence, the Portland market update, the Arizona market update, and then an Intel employee who is left the company to pursue his own real estate career here. David Long, is constructing a resort in Patagonia in South America. So I'm looking forward to that talk as well. All right. I think we're starting to hit our quorum, I would imagine, or yeah, we've got 111 people on the line. So KK, it's a pleasure to have you here. I love talking to you. And I'll turn it over to you.
Thank you very much, Daniel. Thank you for having me on your show here today with so many awesome people from Intel. I'm glad I'm here today. So let me share my screen, please. That way it's going to be easy to understand me. So my name is, in the meantime, I share my screen. My name is KK, full name is Krishan Singh. From Fort Wayne, Indiana. I'm basically from India, came here as a Microsoft certified system engineer in 2000. And I lost my job after 9/11. and got into the gas station business because some of my friends had gas stations, so they offered me a partnership in their gas station business, and I got into gas station business back in 2001. And I have been in the gas station business. I have 8 gas stations. I have a couple of laundromats and a banquet hall. So we grew from 2001 from the gas station to all the other asset classes. We had single family actually. We sold back in May of this year, and we have multifamily. So far, I'm invested passively in 13 multifamily deals, and 5 of them I have been a GP on. So I'm going to share my story with you guys today. Daniel, can you please give me an access to share my screen?
Yes, I just made you a presenter. You should be able to do that now. Do you see a share button down at the bottom of the WebEx? Should be right in the middle at the bottom.
It says, no, it says stop video. Stop video, mute, and share button is not highlighted yet.
Share button's not highlighted. Okay. It says to me that you are a presenter. Maybe if you stop your video, it'll update the buttons down there.
Hang on, allow WebEx open the system preference, and I might have to allow that in my system preferences.
Okay. You emailed your presentation to me, right?
I don't think so.
Yeah, it was the very last minute. Why don't you do that really quickly? And if you're not able to present, then I will put it up for you.
No, I think I will be able to present.
Okay.
All I have to do is share, and
yeah, it was KK and I didn't touch base until this morning and verify that he was going to be here today. And so yesterday I was actually kind of working on a different presentation on options, real estate options, and lease option strategies. And but KK's here, so we're gonna let him continue, and we'll keep that for later.
No, Daniel, I'm going to share that with you.
Okay.
I'm going to share that so that you can share it on your screen, and that way real quick rather than allowing my computer. So I did send that to you.
Okay, you sent it to my email?
Yeah, in the meantime, you open, I'm going to be speaking about, so guys, why I picked up multifamily, that there are several reasons why everyone should be investing in multifamily. I have invested over $1 million in my own deals as well as passive with other operators. So the main reason I had to get from all other businesses to the multifamily was the taxes, because I was paying a lot of taxes because I was making money on the gas station, laundromats, single family portfolio that I had, which I sold back in May of 20. It was 40 single family houses that we bought as a portfolio from a local guy here. And that was our starting into the multifamily space. No, sorry, the real estate space. And immediately after buying those single family units, I realized that this is not the way to scale. So I started reading more about the multifamily and got into the multifamily soon after acquiring that 40 single family houses. I did manage myself to learn the business. So I managed those 40 single family houses myself for a time of 5 years. I allowed me to manage those single family houses. So I had to spend very little time as compared to too much time managing these 40 single family houses. So, but soon after acquiring those, I decided to go into multifamily. So I decided to sell those last year. We sold as a portfolio to one company, and we 10x our money in 5 years. That was great. And also, while managing my single family portfolio, I just wanted to check, Daniel, because I can't see you guys. So is everything okay?
I just received your presentation. We can hear you loud and clear.
Okay.
I was going to ask you too. I know you've got a great story about how you acquired those 40 houses, and some of the people here might be interested in how to acquire more than one single family home in a portfolio. So circle back to that if you would sometime.
Yeah, I can. So I met this gentleman who was in his 80s, starting 80s. So he wanted to get out of this portfolio. He offered me a portfolio at our church. We call it Gurdwara. So he offered me that at the church, and he wanted to sell it to me. And I had never been in the multifamily or single family space, never been in the rental business. So I was a little scared, but he said he's going to help me for 1 year, and also he's going to self finance. So that was a good opportunity, and he also offered me a very good price on those because he really wanted to get out of those single family portfolio, and he had previously sold that portfolio twice, but the buyers couldn't get the financing. So he had to waste 6 months waiting for them to get the financing. And he decided them to sell to me because he knew that I could get financing. So I just bought 33 from him and 7 from his son. And in my transaction, at one point, he said, why don't you go to a bank and get the financing? So I went to the bank and got the financing. In return, he gave me one house for free because he had promised me to do the self-financing, and he decided to back out on that. But immediately after I bought the portfolio, I went with him to work for about less than 2 weeks. It was about 10 days. And I realized that he was old school, and he was doing everything with the pen and pencil, paper. And I couldn't do that because I had other businesses. So I did let him go after 10 days and got on my own. I uploaded all my single family portfolio to a software, property management software, and managed from that software for the rest of the 5 years. And that made my life very easy so that the tenants could directly complain from the portal and pay at the portal. So I didn't have to sit in the office like he did. I kept doing my work. I kept getting into multifamily and managing my gas stations as well at the same time. So I didn't have to be there in the office. So I was working most of the time from my home. So we had an office for the rental company, but I was there only for signing leases. Other than that, my maintenance guys had an access to the office if they wanted some stuff out of theirs. So that's how my single family portfolio management experience was.
All right. Hey, KK, I have your presentation and I believe that it is displaying. Do you see it? Does everybody else see it?
I
Yep,
don't
it's
see it
there.
yet, but
Okay, good.
yep.
And do you guys want me to stay like this, or do you want me to switch it into presentation mode?
Presentation mode,
I-
please.
Presentation mode would be
Okay.
good.
Tell me if it disappears when I do it. Still see it?
Still there.
Yep.
Okay, great. All right. Your presentation is up. KK, I'll monitor the chat for you, so you don't have to do that, and I'll
Okay,
bring up
great.
any questions that people in the group put into the chat.
Yeah. And Daniel, you can bring up the questions as we go. That way
Okay.
we can cover all the questions. And it's a long presentation. Let's keep.
Okay.
I think it's 41 slides, all about single family, all about multifamily investing and syndication. So we'll go a little quicker. So here's a disclaimer. I'm not an investment advisor, and this presentation is for educational purposes only. All investments involve different level of risk, and you should be aware and your risk tolerance level and financial situation. You're free to accept or reject all my recommendations, which are subject to the market risk. As you all know, a recommendation is not a guarantee of any kind. Do not invest your money on my recommendations alone, and do your own due diligence and consult a professional advisor.
I would also add to that because I'm not good at saying this, but the views here do not represent Intel or any group of Intel.
Correct. Next slide, please. So why multifamily? So there are several asset classes called as multifamily as well. The student housing, the apartments, the mobile homes, they're all called multifamily, but it's all your choice. I have opted apartments as compared to other asset classes because I like this the best, and most of the people use this, but there are people who love doing mobile homes or the student housing or old age, but all those classes are multifamily asset classes. So why multifamily? There are different types of properties in group in the multifamily. So there are a lot of benefits to multifamily. Daniel, can you make this a full screen, please?
Is it not? The presentation's full screen for me, is it not?
I think that is full screen.
Okay.
I've been seeing it full screen.
Oh,
I'm on the agenda slide currently.
no, that's the yep. This is the agenda. Go to the next, please.
Okay. And next.
So multifamily, this is why we need to be in multifamily, because the country needs 4.6 new apartments by 2030, and there is no way we can build those. So because of the population growth, the immigration, and the changing the lifestyle of the people. The millennials do not like to own houses as compared to us. So they like to live in apartments. They like to move around the country. So
sorry, KK, I muted everybody, and sometimes it mutes the person speaking and sometimes it doesn't. Are you unmuted?
yeah, I unmuted myself.
Good.
So
Thank you.
if I'll go over this again. So the country needs 4.6 million new apartments by 2030, and there is no way we can build all those by 2030. So the demand demand for the multifamily is going to be great over the next coming years because of the population growth, the immigration to the country, and the changing lifestyle of the millennials. The millennials do not like to own houses as compared to people like us. They like to live in apartments with amenities, and also they like to move from place to place all over the country. They want to live different lifestyle than people used to. So that's why we need more apartments than ever. Next, please. So here's another graph, and all this data is from weareapartments.org. It's a nonprofit organization that maintains all this data, and you can check this website as well for the demand. So anything that is in demand, that's where we want to all go. Next, please. Again, this information is about the same kind of information that shows the demand for the apartments is outpacing the supply in the next 10 years, unless they find some other way to build them quicker. So why invest in multifamily? Let's go over there. So number one is because of the cash flow. The multifamily properties can generate enough cash flow so that it can be divided between the investors as well as the general partners. Next, please. Forced appreciation. So the appreciation can be forced into multifamily as compared to single family. This means that when you add value to the property, and because the prices of the multifamily is based on the net operating income of the property. So if you buy a property, multifamily property, and increase the value of the, you can increase the value of the property by adding value, means renovating the property, raising the rents, and increasing the net operating income. You can increase the value of the property as compared to single family does not. In the prices cannot be increased by adding value because the single family prices are based on the appraisals of the neighborhood, the houses that have been sold in your neighborhood, whereas in multifamily you can add value to the property and increase the value of the property. Next, please. Professional management. So in multifamily we can afford we can easily afford the professional management. They manage thousands and thousands of units as compared to people like us managing our own single family portfolio. We could go wrong on so many places because normally people are not trained for that. But multifamily, they are properly trained, and they have a huge team of management level managers, lease managers, maintenance guys, and everyone, and they are pretty organized as compared to landlords. Next, please. Of course, land, these real estate, whether it's a single family or commercial or apartments, they are inflation protection. That's another reason for us to invest in multifamily. Next, please. Tax benefit. I talked about the tax benefits before. Also, in my case, you can, the best benefit in this multifamily as compared to any other asset class is that you can get the cost segregation done, and you can take all the accelerated bonus depreciation in the very first year. So even though you got profit, but you will still be getting a paper loss, and you can wash off your other passive income with this passive loss. And it depends on person to person how you are structured, but in my case I had a great benefit of this multifamily investment because I had a lot of other passive income. So I have been doing that for last 4 or 5 years. I've been writing on my passive income with this passive losses from multifamily. Next, please. So economies of scale, because you are dealing with now hundreds of doors as compared to a limited number of doors. So vacancies impact your cash flow. So if you have like 5% vacancy out of 100 unit, you have only 5. But if you have a single family home and if you have 2 of them, and one of them, and they take a longer time to fill back up and turnover as compared to the multifamily. And also when you are buying appliances or getting some other stuff done, maybe the renovations. For example, if you want to renovate the whole apartment unit, you can do it for maximum of 10,000, ranging from 5 to 10,000, with everything look like a new, as compared to a single family where you might end up spending $30,000 to $50,000 for the same size of the house to renovate from inside and outside as well. Next, please. So there are some downsides of as well. Everything is not good because the investments are illiquid. So if you are investing in a syndication and you cannot sell it, you don't have much control. You have lack of control over these investments. So you depend on the operators to manage your funds, and they decide when to sell and what to do. So you have lack of control. And also you can't use this money for 1031 exchange in most of the cases. Some cases you may, most of the cases you may not, or even vice versa. If you sold a house, you want to invest that money into a syndication, that's a little difficult as well. So this can happen, but normal cases it doesn't happen. But it's not impossible. It does happen, but most of the cases it doesn't. Next, please.
We actually have a question that's on topic.
Sure.
So Abhisha is asking, with the single family homes, there's an opportunity to hold indefinitely, recoup the investment, and benefit from appreciation. With multifamily, you have to recoup and then invest serially, meaning that it's sold and you have to go into a new one. Do you consider
Correct.
this a drawback of multifamily versus single family?
Well, you're right and wrong. The reason being because if you can make your money, if you can double your money in 5 years, why would you stuck to that property? And the second thing is you have the benefit of diversification between properties, between the markets, and also the operators. So you have a lot more benefit than owning a single family for a long time. But if, and probably Daniel, you know that a lot of times it makes more sense to hold it for 5 years, especially value-add properties, than 7 years. So in 5 years, you might double the money, but in 7 years, it might go just a little bit up because you have already taken the benefit of adding value and increase the value already.
Yeah, it's interesting when you model out the return on investment for these properties. There's a certain point at which there's a maximum,
Yeah,
and then over that, the return, yeah, goes down after that.
Yeah, you don't want to hold it for a long time because it makes sense once you have executed your business plan, you have renovated the property, you have repositioned the property, and you get your returns in 5 years. And after that is little appreciation every year. Why would you want to hold it for a longer time? You want to move on with your same investment in another deal where you can do it in the same market, you can do it in a different market, you can do it with different operator. For example, if your operator didn't do very well or that market didn't do very well, you can move on to the other market and the other operators.
And then really quickly, a question that jumps back to the housing. What property management software did you use?
Buildium.com.
Yep.
Yep. I
All
just closed my subscription today on that. Because I was waiting for the taxes to be done. So Buildium and Appfolio, these are the two most used in the single family, and Buildium works very well. They have improved it a lot over these 5 years.
You say you just closed it down, though. Did you move over to Appfolio?
Well, I sold my portfolio.
Oh, congratulations.
I sold my portfolio, so I was waiting for my accountant to do the tax returns because he had an access to Buildium as well. So now I don't need Buildium, so I canceled my subscription today.
All right. All right. If there are any other questions, put them in the chat, and we'll bring
Keep
them
moving.
to KK's attention. Yep.
Let's move on to the next screen, please.
Oop. Oh, I think I just went to the top. No.
Okay.
There we are.
So these are the type of multifamily classes I talked about a little bit. So there are like these mobile homes, and then there are towers, and there are these garden style. These are typical different types of multifamily properties. Next slide, please. So multifamily versus single family residential. As I talked, price is determined in the multifamily. Price is determined by the market cap rate and the income produced, net operating income. Higher the price of entry is equal to not your typical do-it-yourself house flipping investor. So it's different. Multifamily is a little different than residential. So the repairs also can be higher or less overall, depending on if you need, because it's got a one roof, so many tenants under the same roof. And again, the benefit of scalability and the residential price are determined by the other houses prices, the comparables in the area. And I don't know about this. Some people do, some people don't. Homes have more emotional attachment as compared to apartments. I when I came from India, I still visit that apartment where I started my journey here in United States. So I have an emotional attachment with the apartments as well. So residential, again, either you have the whole rent or you have nothing. As compared to apartments, you have, if you have even a four complex, you one of your tenants leaves, you still have three other paying. So next, please. There are four classes in the multifamily: A, B, C, and D. A is, and every market has different, there's no hard and fast rule for this. Just to give you an idea that there are four different classes. The A class is pretty new. And if it's A class could be, if it's in an A area and if it's not very new, still it could be A class as compared to smaller cities. So then the B class is mostly over 20 years life, over 20 years to 40 years in most of the markets. And the cap rate varies on asset classes as well. Sorry, the multifamily classes. The A class, the cap rates are lower. B class is the cap rates are little higher than the A class. And C class are mostly the working class, the blue collar job people, and those are even little higher cap rate, and those are mostly over 40 years old, and also they need a lot of work as compared to B. And D are war zones. I call them war zones. And I always, that's why I have it at the bottom. I always suggest to stay away from the D class if you don't have, even if you are investing passively, D class have more risk. So if you are not very familiar with this market, the market, and stay away from D class. Next, please. So terminology, we have been talking about the NOI. It's NOI is net operating income. Rental income, if the rental income is 150,000 and minus expenses is equal to net operating income. And the multifamily values are based on the net operating income and cap rate of the property, cap rate of the market, the net operating of the property and the cap rate of the market. Next, please. Again, example of capitalization rate. Cap rate is equal to NOI divided by the price. So here's an example. Next, please. Cash on cash return is something people like to look on when they invest, whether it's they invest in as passively or actively. This is one cash on cash or return on your investment are two different terms, but people like to look at their cash on cash. Here is an example as well. And also cash on cash is cash flow divided by the down payment. Next, please. Again, this is an example of residential. So anything below 4 units is considered residential, and it's for the starters who want to start. A lot of people who start in multifamily, they buy this kind of duplex, triplex, or quadplex, and they live in one portion and they rent, and they can get a conventional loan on these kind of properties for 30 years, which is not normally available in larger units. So, but on this, it is available on larger units, but that's a different kind of loan. I'm going to talk in a second about that as well. But this is based on your personal credit, and it's you sign it personally, but the benefit is you get cheap rate, low down payment, and also you can live in one and you can rent the others, and you can have somebody else pay for your mortgage as well.
Hey, KK.
Yes, sir.
Abhishek is asking, what are some good websites for cap rate data?
I mostly use Yardi.
Okay, and that's a pay service, correct?
It's a paid service.
Yeah.
Yep.
Do you know of any free services? Just personally, I don't. It's
Well,
mainly for
free
brokers.
services don't. The best thing to do is for free services, call the brokers.
Yeah.
Call the
Okay.
broker and get the cap rate of the market and the sub market as well. But there are no free services. But there might be some free services, but the data won't be that accurate because Yardi has all the data. So it's based on the previous sales. And CoStar report also has the cap rates.
Mm-hmm.
But
Yardi,
Yardi prints it every month.
Yardi actually has a property management business too, and so they have
Correct.
accurate values as opposed to survey.
They have accurate data.
Yep.
So commercial multifamily is anything 5 or more, and you get commercial loans on this kind of properties if it's 5 or more. And also on larger properties, I'm going to talk about the non-recourse and the recourse loans as well. But the advantages of commercial multifamily properties under one roof means easier management and forced appreciation, as we talked about, the tax benefits, and also they hold their value, and also they increase their value if you just change the type of tenants. You don't do anything, because a lot of times if in 5, 10, 20 units, a lot of landlords self-manage, and they don't do a pretty good job. They don't do screening. They bring in bad tenants. But if you buy that kind of property, even if it's a smaller property, and you get good tenants into that property, paying tenants, high rent paying tenants, and you provide them some services, you can increase the value of the property. Of course, we talked about the economy of scale, and then agency non-recourse loans are normally available on larger properties, larger loans over $1 million. That means non-recourse loans, you don't have to personally guarantee them. You still have to sign them, but you don't have to personally guarantee them. They are based on the net operating income of the property, and they are totally so kind of bank does some underwriting for you to make sure that the property will produce enough cash flow to pay their mortgage as well. Next, please. Here's some examples how to evaluate multifamily. So net operating, again, NOI. This is example of net operating income, income minus expenses. This gives an example here. And the value of the property is net operating income divided by the cap rate. So that example shows you the value of the property. So if you normally these days, nobody puts a value like the single family, they'll ask $500,000 asking price. On the multifamily, nobody asks, because it's hard. It used to be, people used to have an asking price, but now nobody prices the property. They ask you to bid on it. They ask you to bring the price. So there are calculators like this. They have all these built into those calculators where you can evaluate the value of the property, or you can do this by dividing net operating income divided by the cap rate, gives you the value of the property. Next, please. So here is an example. How can you add value? How you can add value and increase the value of the property. So here's an example of 200 units, 200 unit complex. You increase the rent by just $25 by providing them some kind of service or something, just $25 per unit for 200 unit. In 1 year, if it's the market cap rate is 7%, it increases the value by $850,000. It increases the price of the property. So here are some of the steps to buy multifamily. Pick a market, do your evaluation on a market, because it's very important that you don't want to get into a market where there is no population growth, rent growth, or job growth, or if there is crime. So there are ways to do all that research online these days. So you can pick a market even in a different state. And also the same thing with the submarket, and then find the once you decide that this is the market I'm going to go into, then decide the submarket in that market, and then you find the property in that market, and then you evaluate and underwrite the deal. This is the next step, to do due diligence on that property, put it under contract, then find either and this multifamily is a very nice game where you can buy a larger property without investing your own money, or very little money, I would say. You might have to invest money upfront, and sometimes people don't do that, even because they use other people and give them a piece of the pie. They give them a 5% GP share, and they use their money as the risk money, or the earnest money. Because we call it risk money as well, because you could lose the earnest money as well if you don't close. And you can raise private money from private investors and do these deals. And some operators do 4 deals a year with other people's money. And then you arrange for a loan, close the deal, and then manage yourself or hire a management company. If it's a larger property, you should always hire a management company to manage the property.
Hey, KK, we have another question.
Sure.
What are some good places to research markets about rent growth, job growth, and crime data?
Okay. The best is, and cheap, or not cheap, it's free. It's a city.gov. City.gov has all the data. It has the crime rate, it has the population growth, it doesn't have the rent growth. Rent growth, you can go to Rent Cafe or Yardi as well. Yardi is again a paid subscription, and then you can evaluate. There are Neighborhood Scout, CoStar. There are other several websites where you can do the submarket research and the market research. But if you want to do it for free, the city.gov is the best place to do it. And all other websites also get the data from either census.gov or the city.com.
All right, David is asking, do you have an example of private money? Are these small banks?
No, private money is from private individuals, your friends and family, your network, your people working with you, your co-workers, people you went to college with. That's private money.
Okay. And Cynthia is also recommending rentometer.com as a good place
Rentometer,
to...
yep.
Yep. Okay. All right. Next slide.
Yes, please. So life cycle of a multifamily project, and we talked about this, that why we hold only for 5 years, because its life cycle is 5 years, and you get mostly your best returns in 5 to 7 years. So you don't need to hold it for a long time, and because you get your maximum return and you leave that property and move into, even as not just as a limited partner, as a general partner also, you need to move into another property, larger property, by getting that money and getting out of that deal, because after 5-6 years, it won't produce as much. It will produce the cash flow, but the value of the property won't go up because you have already executed the business plan. Next slide, please. Here is some examples. So pre-offer. So before you offer, you do your market research, you do your market research, you look at the property, do the inspections. You can have an access to the even the paperwork like audit. You can audit the leases, etc., and the finances before you give them an offer. So you can, those are some of the things that you need to before giving an offer. After giving an offer, you arrange for a loan, get an insurance quote, get it inspected, do the due diligence in each and every unit of the property, and then post purchase you execute your business plan. Whatever your business plan is, you execute your business plan after buying the property, and then sale in 5 years. Next, please. So investment strategies, we just talked about what your strategies should be. The best one is the value add opportunities. So if the property has not been renovated for the last 15-20 years, there's a good opportunity to do the value add. That means renovating the property and increasing the rents of the tenants, whether they are new tenants or the existing tenants. Once their lease expires, a lot of people will ask them to move out or move to a renovated unit with a higher rent. So those properties have below average market rents. So there is potential of raising the rents. Or properties needing cosmetic repairs like parking lots, flooring, or the roof, or resurfacing the cabinets or landscaping. Sometimes people don't put money back on the properties, so they kind of look like they're not maintained properly. So if the property has below market vacancies, so somebody is not doing a good job managing the property and the occupancy is below 80%, that's another strategy to bring in a good property management that can raise, let's say, raise the occupancy from 80% to 95%. So you have 15% other paying tenants. That will increase the net operating income of the property. So maybe they are not marketing the property very well. Maybe they are not presenting the property very well. So you can do that as well. Or you can reduce the expenses by putting LED lights or more efficient HVAC. Maybe the previous owner didn't have enough money to put in or didn't raise enough money to put in efficient HVAC systems or smart technology. You can use this, or RUBS. You can pass on the utility bills to a lot of landlords are still paying the utility bills themselves, whereas they can now legally pass them on to the tenants of the property. So maybe that's one strategy as well. If the previous owner did not pass on those utility bills to the tenants, you can go in and use that strategy by passing on the bills and to the utility expenses to the tenants. Better, if you bring in a better property management, they'll raise the net operating income of the property. Or if you can do a reposition as well. If it was kind of a C class tenant base, sometimes the property managements don't care. They don't do screening. They bring in C class, and then B class tenants don't want to be in that neighborhood. You can go in and reposition the property from C to B or B to A by bringing in good tenants and of course by adding some value and amenities to the properties. Next, please.
We have a question from Jess. Jess is asking, is less than 80% occupancy common, especially in areas like Portland, Oregon, for example, where there's less affordable housing? It seems weird to have a property with 80% or less occupancy.
Well, it's not very common, and the average market is not less than 80%, but there are property management companies that are not so efficient. And also, sometimes the landlords are self managing. Mostly, you will find that case in self management. If the landlords are self managing, if somebody is self managing. I have seen properties in great markets like Atlanta that are less than 80% occupied. And that is totally because they're not doing good marketing, they're not presenting their product properly, and they're not taking care of the customer service is really bad because they are the owners facing the tenants, not the employees.
All right. And one other question from another person. What kind of interest rate would one expect to pay for private lending?
I think your audience is still mistaken with private lending and the private money I'm talking about. So this is not that you are taking them as a limited partner. So they are partners, not private lenders. So
Yeah,
you are bringing them in and giving them a share of the entity that own the property. They're not lenders, they're not debt lenders like the banks. Because then they have the risk, they can make more money and they can make less money as well.
Okay. Are we on the right slide here?
Yes. How investors can get into multi? Yep. This is where I'm going to explain what the question is actually. So this process is called syndication. So it started in 2011 with, I think, Frank Dodd's bill, where people could raise money from people they know. And these are SEC, Security Exchange Commission's regulated syndications. So they started with the 506B, where you could raise money from people you know already. And they should have talked to you at least 3 times about this kind of investment before you can offer them an investment. So this started with 506B. Now we have 506C, where you can go advertise, you can put a billboard, or you can go advertise on LinkedIn, Facebook, wherever social media or wherever you want, but they have to be accredited investors only. Whereas in 506B, I'm going to talk that in a little bit also. So basically, this is like buying a property with a bunch of partners who are limited partners. They don't sign the loan. They put their money in. The minimum most of the cases is 50,000. Then they can put their money and they get a piece of the pie. They get a share in the entity that owns the property. So they're actually owners. They get K1. They get profits. They get everything from starting to the end, to the sale, from buying the property to the sale. They are the owners of the property. So it's not they are lending money at 5 to 10% interest. They make more than that. But nowadays there are different different class members. Like they could get 10% straight. In our deal, we had 10% straight for class A members. And then there's class B members where they get 7%, but they get a split at the end as well. They get a split with whatever the sale price of the property. But the class A, they get 10% all the way. They don't get a split at the end. So people structure them differently, but they are the owners of the property. I think, Daniel, you went backwards.
Oh, sorry. And just so you know, we've got 4 minutes left. So at some point here, you'll probably want to put your name and contact information up.
Okay, after this slide, you can go all the way down, and it's my name and everything is
Okay.
there. So syndication, I'm talking about syndication. I just talked that how limited partner, you can bring limited partners to the deal as owners of the property. So there are 4 different types of investors. Equity investors, those are the ones we are talking just a minute ago. So they provide equity for the down payment, and then we get the loan from the bank, and we sign the loan, and we provide the net worth and the liquidity for the bank or the agency loan, whatever type of loan is, and that's how we buy the property. And accredited investors are those people who make more than 200K individually or 300 jointly if they're married, and or they have a net worth of 1 million excluding their primary residence. And then there are sophisticated investors. They are not accredited. They don't make 200,000 or 300,000, but they know about the real estate, and they can invest in 506B, 506B deals. And then else, that everyone else, they are riskiest. They cannot invest unless they become at least a sophisticated investor. They need to know you. The operator need to know them and must have talked to them at least 3 times before they can put a deal on the table and show them, ask them to invest. All right, Daniel.
All right, I'll jump down to.
Yep.
Oop, there we go.
Yep. Can you take to the type of loans? Just it won't take. It will take.
Okay, how far up is that? Type this one.
Two or three. One more slide. Types of loans. Here are the types of loans available for the multifamily class. You can go to bank. You can go to agencies, life insurance companies, CS loans. Then you can go to debt funds. These are bridge loans for the temporarily, if the property is less than 90% occupied, you cannot get agent. There are some rules for getting an agency loan, a long-term loan. So if the property is not occupied 90% for the last 90 days, then you won't get an agency loan. You can get a bridge loan for the 2 to 3 years, and then you can get a permanent loan. And there are private capitals as well, and there is green loans as well. So these are recourse or non-recourse loans.
All right, KK, thank you so much for coming and presenting, and it's always a pleasure to hear from you. We'll put this video inside on the SharePoint so you can look at it later. And thank you for being here, KK.
Thank you. And you can reach me at growrichcapital.com. That's our website. It has more information about multifamily and us as well. And there are some books that you can read as well to learn the multifamily business. Yep.
All right. At Intel, things are usually very precise and on the clock, so people are going for their next meetings.
All right. We are right on time.
Yep.
Thanks, KK. Thanks, Daniel.
Thank you, everyone, for taking time to hear my story today. I appreciate it.
Thank you.
Thank you, Mr. KK, and thank you, Daniel.
Thank you, KK.
Thank you. Thank you.
Thank you, Daniel.
Thank you. Have a good rest of the day, please.
You have the same.
Yeah.
Thank you.
Have
Stay
a great
safe.
weekend, everybody.
Thank you.
Thank you.